This is the Daily Dispatch podcast with your business correspondent, Ted Keenan.
Today, Dispatch Live is talking to
Connie from NVest Securities, and I'm an analyst focusing on the local equities.
And I hope you're focusing on the youth because we're going to talk about youth investment as well. And
it's Liam Graham from NVest Securities. I'm a director there, and I'm one of the portfolio managers.
Okay, Liam, let's kick off with something that is absolutely topical. When a gambler goes to the casino, you never ever hear about how much he's lost. You only hear about how much he's won. Yesterday, cryptocurrencies fell off the cliff. Tell us a little bit about this, please.
It's been a very interesting experiment that has been put to the test currently. So obviously cryptos was based on a decentralized exchange. So essentially moving away from central banks just printing money and having a limited supply of something that retains its value over time. Obviously, currently inflation is rising, and interest rates are rising in step with that. And it's starting to put pressure on Bitcoin. So one of the fundamental drivers of Bitcoin previously was its ability to retain value is suddenly falling off a cliff. Additionally, some of the big trading houses have been suspending withdrawals of Bitcoin as they meet liquidity squeezes, which is also impacting the value of the coin. So it is an interesting time. It's putting the cryptocurrency theory to the test, and I think a lot of people are getting shaken out of their positions.
Would it be correct to say that cryptocurrency is nothing more than a Ponzi scheme?
I think there are certain circles that think that. I think there is a function for the underlying blockchain algorithm. I think cryptocurrency as a means of transaction is probably not in the position where it needs to be. Transactions are too costly and too slow, and they don't compete with monetary fiat at the moment. So I think the founder of FTC, which is the largest cryptocurrency exchange, said that Bitcoin will not be the currency of choice, and some other cryptocurrency will come along that can be traded at much faster, cheaper basis, and that will enable transactions. But we're not there yet. So essentially, it is just an investment. It's hard to work out the underlying value of this investment because it produces no yield or no cash flow. So essentially, it's just people trading it, selling it to someone who's prepared to pay a higher price. And obviously now people are selling it at a lower price.
So while we see crypto at the bottom of the cliff, badly mangled, it's not on life support yet, but to your mind, there's going to be a fundamental change in the operating procedure.
Yes, I think ultimately it has to be regulated. It has got a murky underworld, and I think a lot of the exchanges and governing bodies are looking to try and regulate it and just to try and clean it up. So I think ultimately it will be regulated and it'll be a much cleaner, safer product to deal with. And I think once that gets embraced, then all of a sudden you start getting mass acceptance. And I think that potentially takes it to the next level.
The next hot topic is green energy. This morning, the JSE launched their handbook, their latest handbook on green energy. And very interestingly, there probably were well over 150 journos and related interest groups at this launch. You mentioned before we started that Mike Tyson had a saying about investing in things that are sustainable.
Yeah, I think Mike Tyson's reference was more to boxing, but basically he says everyone has a plan until you get punched in the face. And I think that's what we're seeing at the moment with ESG or green investments, where, you know, it was a nice to have when everything was going hunky-dory, but currently at the moment with the crisis that's going on in Ukraine and the Russia limiting supply of gas into Europe, all of a sudden the coal plants that were closed down to promote cleaner energy are now looking to be reopened just to supply energy into the European market. So it is a tough one. It's obviously of prime social responsibility to sustain the future, but I think at the moment people are more worried about supply now, and I think ESG is getting slightly put on the back burner.
Connie, to say that you are not old will be an understatement. You've recently joined NVest. When we talk about green energy, is this something that the people that you talk to are interested in?
It's not something that's like a core focus for the current environment. People do want to actually go that route because it's more sustainable for the future. But as the current environment and, everything happening, it's kind of taking like a backseat to everything that's happening in the market.
It's interesting that the Oracle of Omaha, Warren Buffett, has got a few rules about investing. One of his first rules is don't lose money. His second rule is observe the first rule. However, Liam, there are certain fundamentals that he speaks about, and that is having a portfolio that's built to survive, focus on value, and do not try and time the market. He talks about owning productive assets. Do those fundamentals still maintain, especially the aspect of don't try and time the market?
Absolutely, and I think in today's environment that couldn't be more important. He talks about understanding value and owning assets that actually produce a cash flow at the end of the day, or produce something that's quite productive. And when we look at the market and this recent sell-off that we've seen, it's important to understand what you hold and why you hold it. And if you can get that right, I think you don't get shaken out in times like this. You're not a forced seller. You don't lock in losses at inappropriate times. And you understand that actually in current environments, there might be more buying opportunities than meets the eye. So absolutely, he's a wise man, old Warren.
Yet, if you listen to the radio, to the financial reports, or you look at the TV, a drop of 0.2% in the market is considered a catastrophe. And the next morning, Japan has bounced back. It's come back another 2 points, and that's considered hallelujah. Does this not just scramble investors' brains?
I think news agencies need to sell headlines, and it's important that they, for them, that they exaggerate those movements. But obviously, when you're in the market daily, those moves are sort of insignificant, and and ultimately, long term is where the value is really created. I think if you look at the current moves we've seen in the market, after last night's sell-off, the S&P 500 is down 20% from the start of the year, and that's technically a bear market. So I think it's important to realize what the market is pricing in, and when you read the headlines, you see the word recession, or we like to call it the R word, bandied about everywhere. So, when you take a step back and you say, actually, what does a recession do to the market? And pretty much over history, the market has typically sold off between 16 and 33% over a soft recession. And with the market down 20% already, it's essentially pricing in a soft recession. So that outcome has already been priced into the market. So if you're confident that a soft recession, it's only going to be a soft recession, then it's not a bad time to look to start to take positions in good quality companies.
They talk about America coughs, the world catches a cold, but the inflation in America now seems to be quite dire. They're talking about 8% or whatever. How does this impact on what we're doing in South Africa?
We're actually in an incredible period at the moment where South Africa is used to 6-7% inflation. That's been basically the average throughout a long-term period. US and the UK and Europe have really experienced these sort of inflation levels. So we're in a predicament when South Africa's inflation is actually a lot less than than the developed world. So we're actually well positioned, and South Africans are used to it. So we don't panic from it. Obviously, South Africans like to moan about things, so we moan a lot, but it's not unusual for us. In the US, they have seen prices move. I mean, their fuel price has moved from $3 a gallon to just over $5 and approaching $5.50. So it's essentially doubled. And they have big gas guzzlers out there. They tend to drive quite a lot. So that's eating into their budgets, and they will be taking strain. But what I would add is that, most of the global consumers are actually in not a bad position. Savings rates are high. Cash in their bank accounts are double what they were in 2019. Debt levels are low, and the ability to service their debt is pretty high. So they have got a little bit of wiggle room to absorb some of this inflation. So if it does prove to be transitionary, and it pulls back in the next 12 months, I think they'll be fine.
The aspect of COVID, it seems as if we're on our way out of it. Does that make any difference at all? I know there are obviously companies that are making drugs and that. Other than that, does COVID have any impact?
Absolutely. So what we have at the moment is we have a dichotomy of policies. The rest of the world, excluding Asia, have moved into a more normalized environment where we've learned to live with COVID and move on. And the daily mechanications are starting to move. China and its surrounds are promoting a zero COVID policy. So what that means is as soon as they find a new case, they shut down cities. So China is a massive growth engine. They're a huge supply chain or production area for the rest of the world. And we actually need them to be producing and to grow the economy, because that essentially supports the rest of the world. So some of the inflation is coming from logistical problems coming out of China, supply chain issues where goods are in shortfall because China's factories have stopped producing because of COVID shutdowns. So absolutely, the world is trying to encourage China to normalize and to sort of live with COVID like they are. They obviously, think their strategy is the best. So it absolutely is still affecting the local and international economies.
The growth of the electric vehicle market has been quite staggering, and analysts talk about the fact that in 10 years' time, if our industry has not changed, we will not be exporting cars out of South Africa unless they are electric cars. There must be knock-on impacts to other industries. Is this something that is a concern to your investors?
No, I don't think it's a concern. I think it's a natural progression or evolution in product. I think the current gas prices is stimulating people's demand for electric vehicles. You've seen the majority of the big car producers announce plans to sort of increase their electric vehicle production over the next 5 to 10 years. So, it absolutely has to be embraced, and there will be opportunities that arise, and obviously companies that fail to adapt will fall by the wayside. So, you've got to be able to spot those. Again, valuation's very important. A lot of the niche companies that are directly associated with electric vehicles have shot the lights out. Most of them aren't even making profits at the moment, so you just got to be wary of that. But I think it's an important trend to follow.
So this would tie in with your philosophy of long-term investment.
Absolutely.
What about the minerals and metals markets and that, which has perhaps saved South Africa? Where do you see that going?
It's an interesting market at the moment. I think the ESG theme that you mentioned and it gathered momentum 5 years prior. I think that's impacted a lot of those commodity companies. It's been harder for them to invest. It's been harder for them to borrow for dirtier projects, which means that supply has been curtailed. So investment has been pulled back, and I think with demand still pretty strong, it's just meant that pricing has increased for them, which is obviously translated to bottom line profits. and they've returned a lot of money to shareholders. BHP last year returned 18% of their share price to shareholders. So, they've been doing really, really well. A lot of them are also trying to move into the clean energy. You've seen BHP buying into fertilizer stocks. A lot of them are moving into lithium and copper to try and embed themselves more into the electric vehicle market. So things are changing. And they're making a lot of money. So I think it's a good place to invest. And as you mentioned, South Africa has been a major beneficiary of that increase in commodity price.
Sectors that are getting your interest at the moment?
Well, at the moment, we are obviously a little bit more defensive. So we like the consumer staple sectors, companies that generate products that consumers can't do without. Essentially your staple products, breads, milks, that you're never going to, they're not the first things you're going to cut out of your budget. We also like some of the tech names here. They've sold off quite a lot, and they offer, exciting valuations versus where they were a year ago. And I think that the prospects for technology over the next 5 years is very exciting. Electric cars is bringing a lot of technology. 5G is bringing a lot of new innovations with it. Automation is going to be a big thing, especially with world populations growth slowing down and wages increasing. So there's a lot of stuff on the go that gets really exciting for some of these tech names. And I think energy is going to be a huge part to play going forward. I think people realize that we can't attach ourselves to one supplier predominantly. So people are looking for new ways of supplying themselves with energy. So that's going to increase investment forward. So there are actually quite a lot of opportunities at the moment. Obviously the market's a scary place. But if you believe something is trading at a discounted value and you've got a long-term time horizon, now's a good time to be accumulating.
Let's talk about the discounted value. It wouldn't be fair on our listeners to Dispatch Live if we didn't ask you for a few stock picks.
I think offshore names like Shell are very attractive. We like Philip Morris here. We think their reduced risk cigarettes are dominating the market. They're growing rapidly. They're 3 times the margin. And I always say to people, the tobacco industries are prime focus for illicit tobacco suppliers, and these reduced risk cigarettes have got a lot more technology involved, and they can protect themselves from that sort of market. And it's an industry that's got incredible pricing power. They get 7% increases in pricing every year with very little fall off in volume. So that's a good one. We continue to like Disney here. We think people that have been locked down for 2 years are now looking for experiences. They're looking to travel. So their parks and entertainment is in a sweet spot for that. We also like their streaming business. They're growing it globally. They're going to basically double their subscribers over the next couple of years. So we think Disney is very, very cheap. Microsoft, Google, Apple, they are massive cornerstones in our portfolios. We continue to think those guys are going to be the giants going forward. They've got enough money on their balance sheets to buy any other company if they feel that they're not in an industry that's growing. And I think locally there's some very exciting opportunities. The banking sector is going from strength to strength. The SA consumer has been remarkably resilient. The numbers we're seeing coming out of the retail companies have been exceptionally strong. And the SA property industry, which has been in the doldrums for probably 5 years, we're starting to hear a word that the power is shifting back to the landlords, which is incredibly exciting. And I think we're about to see a huge structural change in that sector. And I think it offers enormous returns.
Thank you for that, Connie. Liam, thank you for talking to Dispatch Live today. And we look forward to seeing you next time.